You could throw up this chart that Bespoke had out as well on the technical picture, which doesn't look great. 50-day, 200-day moving average. You look at Apple, it's been trading below its 50 and 100-day as well. It represents 7% plus of the S&P and 11% plus of the NASDAQ 100. To get my point, like, the stock has not traded well. It certainly isn't helping the overall market. It's been hurting it. And if it doesn't correct itself soon, how's the market going to find its own footing to get back on this trend, which was overwhelmingly positive?
So I think when you say Apple, I kind of think of that as just a proxy for that Magnificent Seven or Magnificent Eight. And it's an interesting question. I've had a lot of client meetings this week, and they've been saying, like, how can the market go higher? What's going on? And when you say the market needs to stabilize, I would actually argue that the market's kind of surprisingly stable. If we think about it, we're only down 3% or so from the high. We are still at 15+% on the year. And where do we stand? We stand at 20 times earnings right now on the S&P 500. Earnings are 220, put a 20 times multiple on that, that's 440. We're kind of flat over the last 2 years. So I look at the backdrop as remarkably stable. So when we think about the next move higher, does it need to come from the Apple/Magnificent Seven, or can the other 493 stocks move up? I had an interesting conversation yesterday morning. I was on an investment committee call, and it's a large foundation endowment. And what we did was we looked at the overall portfolio, the $1 billion+ exposure to Amazon, Apple, Facebook, and we were very, very relieved, saying to ourselves, okay, we don't have anywhere near market weight in those 7 stocks. We would have been very uncomfortable as an investment committee if we were 7% in Apple, if we were 10% or 11% in other.
Yeah, well, then you're underperforming dramatically, though.
Not dramatically, interestingly.
You have to be. Maybe not dramatically, but you're underperforming.
I mean,
if you're not overweight those stocks, I think, which most have learned this year painfully, if you haven't been in the 7 names, you're probably underperforming. Okay, but this is where I'll argue. If you are a very, very good manager and an active manager and a growth manager, it is absolutely possible to perform in line with the market or outperform without those stocks. And a few weeks ago, I put up on Twitter, I'm like, can people just remind me of who's out there, who's outperforming, who doesn't have that kind of like major Mag 7 large cap exposure? There's a lot of managers out there. There's companies like United Rentals and XPO that are up like 90% on the year. Huge, huge returns. And so you can be in other areas of the market. So my point of this was the whole conversation on this investment committee was, right now there's enormous opportunity outside of the Magnificent Seven. There's international, there's small cap, there's other areas of growth that haven't performed. So I don't actually think that you need the Apples and the Amazons and the Nvidias to continue to go up just to make the market go up. But sorry, can I just say one thing? I really think we're in a mathematical equation right now where I think you need $240 of earnings next year. You need 20 times multiple. Maybe that gives you 3 to 5% upside on the market, but it's math, and you need the other 493 to do the work. Kevin Simpson, I mean, my pushback on that could be, well, the proof is in the pudding, that you need the Magnificent Seven right now to do well, especially at a time where you're wondering about what's really happening with China, where our growth is going, what the Fed's going to do. This notion that you don't, quote unquote, need these 7 stocks to do well, for the market to do well, given all of the other variables, I'm not so sure about that. What do you think?
Yeah, so I agree with you, Scott. I think you need those stocks to move for the market to move. Let's pick up on what Jenny said. We talk about $240 a share for next year for forward earnings. So right now we're at 19 times that. So let's make the assumption that we're fully valued and the market might not go any higher for the rest of the year. I think what Jenny's point is that there's plenty of other stocks that can move higher if you get a catch-up trade. So if the mega techs were over their skis, and I think they were and maybe still are, you've got plenty of other names that can move higher. So theoretically, you could have an index that moves lower while still seeing a heck of a lot of names moving higher.
Tell me why the 493 other names are going to move higher with all these current sort of questions out there. That's, I guess, what ultimately becomes the bottom line. Why would those stocks...
About 4.5% GDP growth, that do anything for you?
Well, I mean, don't go by, be careful how you view the Atlanta Fed's GDP now, right? It's GDP now, not GDP then.
I don't believe anyone's number. I understand what you're saying, but I think there's an opportunity for people to look at the first half as distinct from the second half. And if the first half was characterized by hey, you better at least own market weight, Apple, Microsoft, and maybe be overweight even. Okay, that's fine. That doesn't last forever. Once enough people catch on to that game, those stocks get overowned, and then you see exactly what we just witnessed in Apple this past week. That comes off. The money does go somewhere. Now, we know it's going into bond funds. In fact, we know investors, just by flows, not my opinion, gorging on bond funds. That game will work for a while, too. But at a certain point, if there are companies growing earnings, if there are whole sectors of the economy growing and they aren't just tech, they will get discovered and money will flow there and those stocks will work.